Good morning, everybody. Welcome back to the channel. In today's video, we're going to talk about the top movers and fallers. I'm going to talk about one dividend payment I've received and my thoughts around that specific stock. We're going to talk about the pound falling and what that means for stock prices and what's going on with equities at the moment. And we're also going to talk a bit about UK government debt. So you want to know all of that plus more? Like, comment, subscribe. Help the channel get to 7k subscribers. Follow on Instagram and Twitter at Infant Investors. And if you are wondering what app I'm using to invest, I'm using the free trade application. My link will be in the description and pinned comment. freetrade.io/infant-investors. Sign up, deposit £1, and you will get a free share worth up to £200. Let's get straight into the top movers. The first top mover to talk about is Centamin. Centamin has gone up this week 5.72% according to Free Trade. And there's no real specific news about Centamin, but some of the stuff I'm going to talk about later on in this video about the UK government debt, about the stimulus packages, about the pound falling, I think that's all contributable factors to the fact that commodities are going up. And we've always talked about Centamin riding off the back of commodities, the halo effect for this specific gold mining business, but also it's got its own fundamentals, etc. And if we want to talk about Centamin as a business itself, really healthy balance sheet, really healthy fundamentals, really positive return over the last 1 year, 3 year, 5 year period. So, irrespective of what's going on, this is one of the first stocks I ever bought. In fact, it was part of the first batch of stocks I've ever bought, and it's one that I'm definitely going to continue to hold. And in fact, if I'm being really honest, if the economy was to take an upturn and the sentiment price was to drop, I'm currently at 45%. But let's say that was to fall down to say 20% or 15% or 10% or lower, then actually sentiment has proved itself to be a strong case for me to add a lot more money in, so that when there is the next economic downturn, I'm able to sell and benefit from that. But yeah, overall specific news with sentiment, it's just been doing what it's supposed to do in this current economic climate. Now, the next top mover to talk about is Okta. Now, Okta is up 5.73%, but this is my issue with free trade graphs, and I've mentioned this on a number of occasions. I think when I do these portfolio updates on a Saturday, there's something that just goes wrong in their back-end system in terms of calculating the return for the week, and it kind of just takes a day off, or it loses a whole day, because when you go to any other platform, whether it's Yahoo, whether it's Simply Wall Street, or whether it's even Trading 212, you find a completely different figure. So I'm going to quote you this figure of 5.73%, but elsewhere you will find the figure is actually 18.94% that Okta has actually gone up this week. And the reason why Okta has gone up this week 18.94% is because one of the analysts that was following the stock has raised its price target to $210. We talked about this on a number of occasions in previous weeks, when analysts that follow specific stocks come out and say that they're going to increase their price target, or they say that actually they highly recommend, or it's an overperformer, or it's a buy rating. All of those different signals that they may come out with, it tends to have a positive impact on the stock. They also mentioned that they expect the earnings to increase as well, in the region of around 30% apparently. So that's one of the positive factors for Okta, and why Okta has shot up as well. And I can definitely see it going to a $210 price target. I'm currently sitting at 79% for Okta in terms of my return, and really happy with this business that I purchased back in December. So that is the second top mover. The last top mover, you've guessed it. You guessed it. You know what it is already. Shopify. Listen, this is a madness. Shopify is an absolute madness for me right at this current moment. Quite a few things to talk about on Shopify, as there always is when I talk about Shopify in previous videos. So we can see here, first of all, 9.38%. As I mentioned, in a similar situation to Okta, everywhere else is a completely different figure. I think there is a glitch in the system of free trade, so I'm just going to put this down as an aberration. But when you look elsewhere, you'll find that the actual growth this week was 19.03%. Which is obviously a phenomenal growth to grow by, basically 20% within this week. Now, One of the reasons, the first reason I'm going to refer to is again price target. So RBC Capital Markets have officially raised their price target for Shopify, and they expect the stock this year to go to a $1,000 stock. Now, I mentioned to you guys probably 5, 6, 7, 8 weeks ago that I believe this stock will go to $1,000. You lot can vouch for it. I talk about this stock nearly on a weekly basis if it becomes a top mover. And I mentioned this a long time ago that I genuinely, strongly believe this will be a $1,000 stock. And obviously to see this vindication, I will say, or validation rather, from RBC Capital Markets, which incidentally is a company that Shopify has now overtaken in terms of its valuation from a Canadian equity standpoint. Anyway, that obviously means quite a lot, and one of the reasons why the share price has gone up significantly this week. The second reason why I believe the share price has gone up quite significantly is Shopify has done a partnership with Walmart Marketplace. So Shopify has been doing partnerships with quite a lot of people recently. We spoke about the partnership with Facebook, and we spoke about the bank that they're launching for businesses. They've been doing loads of things, but this Walmart partnership is obviously a trial, but it could mean really significant things for the balance sheet of Shopify. So Walmart this morning announced a new partnership with e-commerce shopping platform Shopify, now used by over 1 million businesses. The deal will open Walmart's marketplace to Shopify small business sellers, with the goal of bringing 1,200 Shopify sellers to the marketplace this year. The partnership will greatly expand the reach of the participating brands by placing them in front of Walmart's marketplace, says 120 million monthly visitors. The partnership is a direct shot at Amazon, which today promises third-party sellers the ability to reach more than 300 million customers worldwide, and even offers to help with shipping, returns, and customer service way fulfilled by Amazon. So effectively, Walmart's marketplace is, a place where, their online shoppers, their 120 million shoppers can buy specific goods. And what's happening now is that Shopify is doing an integration. There's going to be 1,200 selected sellers that they can manage their inventory via the Shopify platform, but it'll be integrated into Walmart's marketplace, and Walmart's customers can buy their purchases. So they're going to go through this specific checks to make sure they're eligible. And once eligible, just by managing their stuff in Shopify, they have another market, another access route in order to sell their goods and services, and potentially can leverage Walmart's logistics and delivery services. Now, obviously, this is starting with 1,200 people, but you can obviously naturally see its propensity for this to scale, much more broadly than just the US and potentially globally as well. So it's going to be, I think, a really significant play in increasing Shopify's market share, for one. Obviously, taken a bit of the pie from Amazon, which I don't think they're going to do easily. Like, I don't want to say that flippantly, but I do think they'll be eating into it over a number of years. And then obviously, helping Walmart also in the process potentially grow as well. So it's a really significant move. And I think it's obviously one of the contributable factors to Shopify's share price going up about 19.03%. And so if you look at my portfolio, I'm currently at 182% return with Shopify. Obviously, I only ever bought once back in October 2019, so not that long ago. It's not even been a year yet, but obviously 182%. And I definitely believe I'll get to the 200% return mark with Shopify once it starts to hit the 1,000, and I will continue to hold. I mentioned the only reason I'll shell Shopify is when the real genuine recession actually gets announced, the technical definition, and people actually curb consumer spending, and that's one of the reasons. If you look at, Shopify launched in the public markets back in 2015, and you can see it's gone up 2,284%. Let me give you a fun fact. If you invested £500 at the beginning when it launched onto the public markets, you'd have £12,000 right now. £12,000 in 5 years later, just by investing £500. So when people talk about the barrier to entry and the ability to invest, you don't have to have a lot of money to invest to actually make money. You just need to find the right opportunities, and that is difficult. We're not going to say finding the right opportunities is easy. Sometimes it's a bit of luck, sometimes a lot of work might go into it, but if you can find the right opportunities over the long term, it can be really, really beneficial for you with a very small upfront investment. If you invested £500, you'd have 12k at the end of 5 years. That's an average of £2,400 per year, which is basically like if you was a dividend investor getting a £200 a month monthly dividend. And if I convert that to a yield, that's like a 40% monthly dividend yield each month. That's quick maths, fam. Quick maths. And it just goes to show you that we cannot knock growth stocks. I know some people are wholeheartedly dividend investors, but a lot of those dividend businesses have already grown so much that you will be getting, your 1%, your 2%. With certain growth stocks, you can really actually increase your wealth and increase, your opportunities for the future. So I personally think growth stocks is really important to have as part of your portfolio. It's something I neglected at the beginning due to availability within the platform that I'm using, Free Trade. But since they became available, I obviously have introduced a lot, and it's something that I really want to go to. But I just wanted to put those stats out there just to show you that, growth stocks doesn't have to be necessarily high risk. It doesn't have to necessarily be a lot of money you need to put in to make a lot of money. You could put £500 in, wait 5 years, and that's 12 grand, which is £2,400 a month. And I personally would be more than happy to pick the next 10 IPOs, put £500 in, and even if just 3 of them manifested as 12 grand plays 5 years later, that will more than combat the investment that I put in all the other 7 anyway. So that's the type of way to potentially think about these things. Anyway, let me move on. Shopify has done fantastic, and I shall move on to the top fallers. Now, first top faller to talk about is Uber. Now, Uber, you can see, has gone down 1.13%, but again, if you look elsewhere, it's actually gone up 0.12%. So there's not been that much negative news about Uber specifically. I have actually found some news which is pretty niche, but because of the industry I work in, I personally feel like this could be a good way for Uber to divest its products and services and actually find another way to make a genuine revenue stream. So what Uber's actually doing, they're repurposing their software as a SaaS product, software as a service product. So think things like Salesforce. It's like a CRM platform that any business can use. Uber is repurposing their software for specific businesses to use. Now, the businesses that they're referring to at the moment is the government, California government's public transport, blah, 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 commission or whatever. And effectively, they will license their product to them for them to use that platform as a way to offer, public services such as buses, trains, or whatever else they've got there. So it's basically upgrading their systems, and instead of using their own antiquated system, they'll be using Uber's system. Now, it is a trial, and it's very early, and I found it in the back pages of one of them proper niche articles. But sometimes it's those things that actually give you an insight into what's going to happen in the future. So if this works, then this potentially could be rolled out to many different governments and local authorities, not just within the US, but around the world. And again, that provides now a business to business revenue stream for Uber, where they've primarily been focused on business to consumer. That could be massive, because typically business to business businesses, it's a lot of business there, isn't it, fam? A lot of business there. Business to business businesses typically have higher revenues than obviously business to consumer. I mean, it depends. I mean, that's probably a bit of a wild statement, but it does depend. But I guess they potentially have safer or more sturdier revenues due to the nature of their clientele and their customer base. So I personally think that could be quite big for Uber. Even though it's gone down, it's actually made me think maybe it might be worth taking a punt and putting a little bit more money into Uber now, and then just leaving it and just seeing what happens over the next 1-2 years. But it's most certainly a stock I'm going to continue to hold. The next one to talk about is Nikola. Now, Nikola, you guys saw me talk about it as a punt. I invested last week. You can see the date here, the 12th of June. It's actually up 5.1% for me, but it's showing 3.27% down here. If you go to excusez-moi, if you go to Trading 212, it says it's gone up 3.11% over the past week. So again, this is symptomatic of the graph issue and the data issue that you're seeing here with Free Trade. So it's not really a top faller, but it's the top faller in terms of the data that I've got in front of me. Listen, we're going to chop this one up separately. We're going to chop this one completely separately because I'm actually up, as I mentioned, and there's a lot to unpack with Nikola. I mean, there's some stuff about lawsuits. There's some stuff about a Phoenix factory that's going to be open. Ultimately, this is a business that has got no products just yet. I did take it as a punt, but I only put £300 in. So I've received a lot of comments like, why would you do that? Why would you do that? Guys, it's £300. in the context of my overall portfolio, it's not a big deal, and it's just something that I would like to see what happens. I like to monitor the situation, and I won't monitor it if I haven't put no money in it. I like to have skin in the game. It's just the way I operate. So we're just gonna move on from that one. The last top faller to talk about is Legal and General. So Legal and General has gone down according to Fruche 3.45%, but according to everywhere else it's gone up 0.85%. So listen, we did this before when I used to talk about the Simply Wall Street figures versus the free trade figures, and then I decided just to talk free trade. But I think in some of these instances, it's worth calling out that it's not correct and it's not accurate. And there are obviously other data sources that are showing different things because it might influence your decision making. So it's definitely worth that if you are looking at a specific week's performance on a Saturday and you're thinking, oh, my stock went down 3.45%, just look in a few other places as well, just to clarify, just to make sure, just to validate that, so that you don't make some rash decisions based off inaccurate data. But in the case of Legal in General, there's not been that much by way of news that I think significantly impacts the movement of the stock. We've seen talks about £100 million partnership with their LGIM, Legal in General investment management arm, which is financing Bromford Housing Group to build properties until 2028. Nothing significant there. That's part and parcel of their general operations as part of that business. We've seen some talk about them building retirement homes. Again, nothing specifically substantial. So we shall move on. And the next thing to talk about is the fact that I've received one dividend payment this week. And that dividend payment I received, you can see here, is from Micro Hard. And Micro Hard paid me £2.75 as a dividend. It's a quarterly dividend payer, as are the vast majority of US stocks. And you know what? I just see this as an equity bonus. An equity bonus is, listen, I don't personally, I mentioned this when I bought Microsoft. I mentioned this when I bought Apple. I don't personally, look at it for the dividend payment. The dividend yield is like 1%. It's not something that's driving me. I'm buying it because I personally perceive these businesses as growth stocks. Now, maybe in the correct classification by Wall Street or whatever, they see it as a dividend player or whatever. I don't. I see it as a growth stock just because of the dynamic of the business. I believe that Micro Hard, and let me go to the actual portfolio here. It is a dominant tech business, their emerging cloud services arm, which has made a significant improvement to its share price when you look at it over the past year. And I'm talking about this movement here. Obviously, this corona situation dropped, but it rebounded as did most other stocks, to be fair. We're seeing consistent growing revenues. We're seeing consistent growing profits. It's got a world-class CEO, and I'm talking about Satya Nadella. I'm not talking about, Bill Gates, because he's not a CEO or the chairman. He stepped down from Microsoft. I'm talking about Satya Nadella. And that's the reason why I've invested into this business. So currently I'm sitting at 20.9%. And I personally see Microsoft and Apple like a savings account almost. I see them, because they are 1 trillion valuation businesses that are still growing, I see them as like a really high interest savings account. That's my personal frame of reference. Obviously, everyone's going to see them different. And then I get my equity bonus at the end of each quarter, which is going to be, £2, £3, £4. It will grow, obviously, as I grow my shareholding with, obviously, the business. But, that's why I call them Micro Hard. Okay, there's nothing soft about it, fam. There's nothing soft about this business. This business goes too hard, and I genuinely really love the business, and question myself on why I didn't invest much earlier. So yeah, growth B, that's what I'm on, and I can't really shed any more light on that one there. Carl, we're moving to the fact that the pound is falling this week. The pound is at $1.24, so we're seeing that the pound is falling, and some of the reasons why the pound is dropping is obviously the 100 billion quantitative easing care pack, the care package for all of you Call of Duty fans that have dropped in from the AO, and has helped businesses and the economy basically continue operations, and hopefully protect jobs, protect businesses from going under, and obviously increase consumer spending as well. So what that's actually happened is that there was an expectation that during the third quarter there'll be an increase in consumer spending, but due to obviously lockdown restrictions over the past couple of weeks, then we're actually seeing that there was an increased level of consumer spending over the past couple of weeks, over the past month or so actually. And the contraction that was forecasted to be about 27% for the first half of the year is now at 20%, which is still a big contraction. It means we will be in a technical recession, but obviously it's showing positive signs of the curve going in the better direction. And overall, that's why I feel the market over the past week, you can see from the 7-day graph here, has taken a slight uptick. Like, I've not put any money into this portfolio over the last week, but you can see how much the value has risen from, about 380 to 36066 in that portfolio, and the same has pretty much happened in my basic account portfolio as well. So that natural uptick has basically been some of those factors that I just basically mentioned. One thing we've talked about in previous videos, so for those of you that are new and want to understand the correlation between currencies and equities, effectively when the pound falls, equities tend to rise. When the pound rises, equities tends to fall. Why is that? Well, when the pound is falling, international companies, international institutions tend to buy into US equities because they're getting it at a cheaper rate. So when they're converting their currency into the UK, they're getting it at a cheaper rate, and they're basically buying UK businesses at a much cheaper cost. And so that's what typically boosts the UK economy. The UK equities market when the pound does fall, and obviously when the pound rises, the inverse. There are some other layers to that. I've really tried to simplify it just for the purpose of keeping it succinct. There are some layers to that, but overall that's kind of the relationship between the currency movements as well. So it can be actually quite important when you are investing into US stocks or overseas stocks, trying to understand that dynamic as well between the pound and obviously the dollar. So now the pound has fallen towards the dollar. It does now mean naturally if you buy a US stock, it's going to be more expensive for you. With that, even if the share price is constant, because the pound has dropped, it's going to be more expensive for you. It's kind of like inflation, right? Like if the price of milk stays exactly the same, but you earn less, or inflation has gone up and the price of milk, you know what I mean. Basically, I'm stuttering here, but the point of the matter is, effectively, it's gonna be a lot more for you. I'm proper distracted by what's out my window. Anyway, let me get back onto it. So listen, I personally, as an investor, don't try to watch or focus or pay too much attention on currency movements, only because I like to buy businesses, and I feel that currency movements is going to happen. It's part and parcel. It's a $5 trillion economy. It's going to always move every single second of the day. It's a 24/7 open market, the forex market. Currencies will always move consistently. So me watching it every single day or trying to time when I buy US stocks, I don't have the energy for it, and I think actually the marginal gain or benefits you might make in that is going to be really, really minimal. What I will say though is when you see the wild swings and the wild headlines, then maybe it's time to freeze in terms of buying or selling at specific points. But generally speaking, find a business that you like, find a business you think is going to grow, and just buy it when you want to buy it, man. And that's how I personally feel about the whole situation, man. I just focus on the business and the percentages. Now, speaking of percentages, 100% we're going to be talking about, and 100% is basically the fact that the UK government debt has exceeded 100% for the first time since 1963. Basically, what we're talking about here is the size of the economy versus the size of the economy's debt. And what we're seeing is that the size of the economy's debt is higher than the size of the economy. Basically, debt to equity ratio, we talk about that on a company level. I talk about that on a personal level. I tell you guys that, I would ideally want all of you guys to be investing without any debt whatsoever. That's, if I had my utopian vision for all of you, that would be my utopian vision, that you have no debt, you have your emergency fund, and then you start investing into the stock market because you've got money to back you up, you've got no liabilities, and you're able to deploy capital when you want. Obviously, that's not going to be the case for all of you. Some of you guys will have debt for good reasons and negative reasons, and so it is what it is. And one thing I mentioned in my budget plan video is to track your debt to equity ratio. So understand what you've got in liabilities versus what you've got in assets, and just understand the value and the correlation and the ratio between the two. Now, obviously, you can track that on a personal level, a company level, which you talk about a lot, but this is on a country level. And it's expected to exceed 300 billion by the end of the year. I didn't say that wrong. Not 3 billion, not 30 billion, 300 billion by the end of the year, which is 3 times as much as the '08 crisis. Guys, we are in the most significant crisis the UK has ever seen, and it's just worth being really mindful of the fact that, you know, whatever we went through before, the 2008 crisis, the Great Depression, the dot-com crash, light work, them thing there were light work compared to what we're going through right now. So if you survive this and you make it through and you actually, you know, figure out how to work the market and how to make, you know, financial opportunities from the current situation, then, you know, it's definitely going to prove you well in the future. And, you know, probably not in our lifetimes will we see something of this nature again. You know, the actual figure is 15% of the national income, which is basically simply, you know, the amount of earned money within a specific country. And so it is a significant amount of government debt at the moment, but it's understandable. Listen, it is understandable. And if the government wasn't doing, you know, all of these stimulus packages and wasn't trying to stimulate the economy, then everyone would be saying, well, what are you doing to protect people? What are you doing to help? So, you know, I mean, I'm not a government, you know, advocate. You guys know I'm very anti-establishment anyway, but from an economic standpoint, when people are losing their jobs, when people are being furloughed, when companies are going under, when consumer spending has fallen to an all-time low, and you want to try and get the economy started again, it's like, you know what I mean, when you're starting an engine on a car and you're just like, you're just revving that, trying to get it started. That's what the government's trying to do with the bag B. They're just trying to drop that care package and get the economy going again. And it is understandable. What the long-term impacts will be of it, I think, remains to be seen. Probably much lower value in the UK economy as a whole, especially from a currency perspective. You know, there's a lot of talks about the UK economy is a mid-sized economy with the most expensive currency. You could potentially see that changing. We might be in a world in 5 years' time where the dollar is worth more than a pound. Do you know what I mean? I remember working in a bank where a pound was $2. People were just literally just switching it up, going to New York, buying clothes, coming back. Like, it was just easy money. Like, it was easy money. And now it's $1.24. Look, we could be in the next 2, 3, 4 years in a world where the dollar actually exceeds the pound. And when you see the bounce back and the rate of the way S&P 500 outgrows the FTSE 100, the way that the US economy outgrows the UK economy, the way it bounces back, just generally speaking, it's not unreasonable. Like, it's so understandable. So I personally see that maybe where it's going, but, you know, it is what it is. Like I've always said to everyone, when the pound falls, it only really matters when you're going abroad, generally speaking. If you are staying within the UK, you're from Herefordshire or Shropshire or Gloucestershire or one of them shires, and you're staying within the UK and you're just buying, you know, goods and services in the UK, typically speaking, you don't really feel the pinch. You might feel the pinch in some slight instances. Definitely if you go on holidays or if you do, you know, import things abroad, potentially you might feel the pinch. But for the majority of people, you won't really feel it. It's only for people that have international exposure, whether it's businesses, small businesses, or individuals that, you know, go internationally or do things internationally a lot. That's when you're going to feel it anyway. So, you know, it's just worth just being mindful of that situation. But yeah, to sum up, because I've just been chatting, fam. Bare saliva in a man's mouth. Listen, to sum up, there are significant opportunities in the market, I personally believe. I think caution should still be absolutely exercised. If you look at the macroeconomic trends that we just discussed, you know, I think there's going to be announcements in the next couple of months about the technical recession, and I think there will be probably another big dip like the one we saw around here. Maybe not as big as it, but there will be a big dip. Pause. And, you know, so I think there's anything wrong with holding cash, you know, taking some profit. You know, I would love to take some of my profits for some of the profitable stocks. I'm not ready to do so just yet, but I will definitely be looking at taking some profits in some stocks, you know, in the next couple of months or so. Just have to see what happens and monitor the situation accordingly. That's the burden of being an active investor. But if there is a dip, then obviously it's going to provide a lot of entry points, you know, for the future. And as I mentioned with the whole, Shopify situation, if you put £500 in 5 years' time, you know, that's 12 grand. You know, with microhard, I forgot to even mention with this specific stock, if you put £1,000 in, you know, 10 years ago, 10 years later, it would be worth £6,500. So again, we're not talking about, you know, putting in £1,000 on a monthly basis to try and become a millionaire here. We're talking about putting a lump sum into a business and just leaving it for the long term, and that actually is probably the most proven way to make a bit of money. So it's definitely something that's just re-energized me in terms of how I perceive the market and how I should view certain things. Sometimes you can get very, you know, micro level, really look into not too much detail. I don't think there's ever too much detail, but you can kind of get caught up in the analysis of smaller things. But if you look at the bigger picture, you know, the stock market is about buying and holding for the long term in a variety of ways. And if you can do that effectively, then, you know, you can benefit. Listen, I hope you found this video useful. If you did, like, comment, subscribe, like, comment, subscribe, and I will catch you this week with more investment videos. Go check out my Trading 212 review that I've done yesterday. Please have a look at that, and, you know, let me know your thoughts and feelings around that. And also, you know, should you sell your stocks, a video that I did earlier this week. Links will be in the description. But yeah, like, comment, subscribe, and I'll catch you next time with another investment video. Take care, guys. Peace.